Welcome to Vitamin B with Mohana. This is where we help you take control of your well-being. My guest today is Vivek Gangadaar, a financial planning expert. As our country is poised for great growth, it becomes so crucial for us to understand the various options of financial instruments around us so we actually can have a comfortable, safe, and great life.
There's a lot of money, tons of money, especially in India. Manufacturing, Make in India campaign has actually hit off pretty well. Next 10 years is going to be a great win for India.
But today there is this whole hangover of what your parents taught you.
From thinking only of saving, now people are thinking of investing.
Indian mindset towards money.
120 crore people have bank accounts. Unfortunately, a lot of youngsters are misguided to invest in stock market through trading.
Where are people investing today and why is that a concern?
So let's say first week of the month you get the salary, and then by 28th, 21st
It's blown up.
it's blown up. So have a risk mitigation. When I say risk mitigation, have the right insurances. Number one, protect your health, life and money. So be transparent. Don't cheat your spouse and your family financially. It's your money, man. You got to be responsible for it.
So
Simple.
spend less, have a passive income.
Correct. Digital real estates,
Okay.
e-real estate. Right?
E-real estate.
Ah.
SWG essentially allows you to take the money out, live with it, plus you can reinvest it somewhere else also.
Never ever have your knowledge borrowed from your Google or online.
Yeah.
Finance is a little different. Emotions of human beings,
Yeah.
fear and greed. Strongly recommend people not to do.
Okay.
Never to get into it unless you're a pro at it.
It's not just that you log in and you have a safe number, but who's behind those apps. So be very conscious about.
People are still thinking, okay, Bitcoin means if I enter, everyone will make money. No. Death and taxes are two things that you cannot escape. 100 minus your age. Let's say I am 44. 100 minus 44, 56.
A lot of older people don't want insurance.
Finance is actually very easy, but unfortunately, it's not been taught the right way.
So come join us as we discuss the overall economic growth of India, understand what are the errors that we typically end up making in terms of financial planning, and what essentials do we need to know, and the latest and greatest on the financial instruments that are around us so we can actually leverage them for a happy, safe, great life. So sit back, relax, and join me at Vitamin B with Mohana. Hi Vivek, wonderful to have you at Vitamin B with Mohana.
Good morning. Thank you so much. Thanks for inviting me.
It's a pleasure. It's absolutely a pleasure. How are you feeling today?
Fantastic. Great as usual. So just, yesterday I concluded a great, financial training session
Sure.
with some youngsters, about 1,800 of them.
Yeah.
So that energy is a little,
Higher.
I think it's kind of passed on to me. I'm
How are
feeling
people
more
feeling
young.
about money these days?
Money, it's actually mixed reaction, to be very honest. There's a lot of money, tons of money, especially in India. People don't know what to do with it. Right? Very few. I would put maybe less than 10% are actually aware of what they need to do with the money. There's money is there. So what happens is basically people end up splurging, buying that, this, and traveling.
Yeah.
That's what
Yeah.
it is.
I mean, that's what we also did when we were younger, right? Or we
There's
were
nothing
asked
wrong.
to save.
There's
Yeah.
nothing wrong also.
Yeah.
Yeah.
No, that's totally great that you're making this kind of a difference, and it's good to have you on the show as well. I very recently moved to start my own entrepreneurial journey, as you know. And at different stages in our life, we suddenly realize that, hey, I actually need to be thinking of my money very, very differently, right? So that's one of the reasons why I personally feel like it's great. And the other important reason to learn is India is at such an amazing juncture. What do we do? How do we view it? How do we understand it, right? So maybe we'll start there itself, Vivek, and it's a fascinating conversation we're going to have today. What do you think about the macroeconomic condition in India today in terms of just the outlook overall?
The overall outlook is actually a very interesting phase that we are in, right? Manufacturing, Make in India campaign has actually hit off pretty well.
Yeah.
And that has actually fueled a lot of growth, economic growth. Second thing is the IT and financial services are actually at its brim already. Agriculture, though there is a lot of weather related fiascos, it's been quite resilient. Agricultural industry. Coming to the other factors, RBI and Indian government is doing great in terms of keeping inflation in check, right? Though if you look at, see, if we have to talk about economic factors, really, there's something called trade deficit, balance of trade, right? And then we have the inflation, and then GDP growth. GDP growth consistently has been around 6 to 7% in India, and I think we continue to be there. Stock market is actually doing pretty well, especially after the US presidential elections that got over, and I think we're slated to grow quite big there, right? So next 10 years is going to be a great win for India.
For India, right? And everyone's talking about it. Everyone's watching. Everyone's also, like what you watch on the news, trying to bring us down. There's a lot of that also happening.
Of
so
course.
Each one of us has a role to do a lot in terms of contributing to our country's growth.
Correct.
Yeah.
Just one more point I want to add, very important to note, is when we say make in India, right?
Yeah.
It's just not only manufacturing, it's also supply chain. Predominantly, US and world over, many countries, right? They have been actually quite dependent on China because of the low labor cost, right? Low cost of services and economy of scale and all that, right? It's slowly started to shift now. There's a campaign specific that's been started. Because of that, everyone world over is looking at India to actually take it forward. So next 10-15 years, I think is going to be like a Diwali phase of India.
For 10 years, that's
10
what we
years.
need to be thinking about.
Yes.
Great. So that's the part, right? That makes me very curious, right? When we were growing up, and I really wish I knew this ahead of time. But then we didn't have instruments of financial planning the way it is today. But today there is this whole hangover of what your parents taught you versus your ability to understand on your own and take a risk. Despite so much growth ahead of us, a lot of people are not investing. So as an expert in this space, how do you describe Indian mindset towards money?
Great question. See, I like the word, hangover, right? Hangovers never last, right? It fades away. So similarly, the mindset is slowly shifting, actually, but consistently shifting towards. Earlier, the mindset our parents had, or the generations before that, was extremely traditional, right? Save. They never even thought about investing, keeping the money in savings account or FD, or real estate or gold. It's physically that they can see. The question is why? If we go behind the mindset of our past generation, folks, right? Why they were thinking like that? There was no social security. Right? They had to always provide for the future, right? There were a lot of uncertainty. What if this doesn't happen? What if I lose my job? Because it's not, the business was limited only for few people who were doing. Not everyone had that guts. They didn't have that in the stomach to really start something. Though few of them have done it. Most of them were all either thinking of taking up a job, government job, and all that. And that itself had its own plus and minus, and that's why they were looking at these traditional classes as this one. Now the same thing moving over to the next generation. Can you even imagine the type of information that's available out there in the on internet? Simple, right? For youngsters to take a look. So the mindset has actually shifted from thinking only of saving. Now people are thinking of investing. Though I would like to tell you one thing. Even though people are thinking of investing, there are some numbers. Okay, you'll be surprised. Today there are out of the Indian population that we have, right? 120 crore people have bank accounts.
That's it.
Okay? And out of that, only 8 crore Indians have demat accounts, which is dematerialized form, right? To invest in stocks. Out of them, only approximately 3 to 4 crores are still investing in mutual funds. Which means the mindset is now shifting.
It's not even 1% of India that's in the market.
Less than 1 or 2%. Right? So now mindset is completely shifting towards investing. It's just that people want to invest, right? But they don't know where to, how to, and all that. There's a lot of confusion. Some of them doing good, some of them not good. So that requires a bit of handholding.
So tell me, Vivek, where are people investing today, and why is that a concern?
Predominantly, sorry to put across some numbers here, but I have done more than around 10,000 people. I have touched upon, right, in terms of training them, corporate trainings or doing the financial coaching and all that. My experience, what I see is people still want that, as you said, that hungover feeling, right? A portion of them, they still want to have it in a secured way, right? FDs are still been, yeah. Though now, so banks have also started to kind of say that many people are not keeping in FDs, right? FD mutual funds, right? And unfortunately, a lot of youngsters are misguided to invest in stock market through trading, through futures options. Hamara Rakesh Junjunwala himself said that, hey, listen, someone like me, I have it in my gut to do trading, and to take up losses, but can you, right? So this is where unfortunately it's happening like that. There was also a data that was released by RBI and SEBI, which stated that out of many people who came in post-COVID, right? Post-COVID, a lot of Indians, because there was a lot of time people were just sitting there and learning on these things, learning from the financial gurus, and they started doing the trading themselves, futures options, and 90 to 95% of them have actually lost money. They don't know, right? So the areas that people are actually looking for investing is mutual funds, stocks, real estate is going great, right? Gold, yes, and by advent of the digital currency, a lot of people are actually Bitcoin and cryptocurrency, yes, and they're doing it the wrong way.
We'll come to that. So Vivek, I would love to talk to you a little bit about your core expertise. So guide us, 3 foundational principles or rules of the game for anyone at any time in their life to manage their financial planning. What do you advise?
3. Number 1, always mitigate your risks. It starts with that, right? See, listen, I think all of us know how to earn money. It's no brainer really, right? Either you earn the salary or you have some incomes coming in, you're doing your hustle or whatever, business. Earning is not a really important thing. There is a bread and butter, we have to do it, right? But you can actually grow your wealth also, investing, right? But people don't, very less emphasis that they give is on risk mitigation. All of your money can actually get wiped out within a day, right? Stock market crashes, COVID scenario, right? For example, just a bit about my background. I was 21 when I lost my dad. He was a CA, chartered accountant, and he stopped the income stop for us. Income stopped, but expenses.
There's so many families like that.
Expenses didn't stop. What do you do, right? So whatever money that my dad had made and assets that they created, everything came down, crashing down. Right? So have a risk mitigation. When I say risk mitigation, have the right insurances. Number 1, protect your health, life, and money. Okay, that's one of the ground rule, I would say. Right. Second thing is always think of what you have created is actually not only for you. It's not. It's for all of your family members. So be transparent. Don't cheat your spouse and your family financially. Right. Be open about it. Have a healthy discussion. Maybe it could be just simple thing like once a week when you're sitting together, family dinner. Just say, hey, you know what? This is the situation right now, financial situation. All it takes is just working with some professionals to put one dashboard and just take a look at it and make sure that gets passed on. Right? Have a good legacy planning. I would call it a succession plan. Right? How you have BCP in a corporate world, you need to have an LCP, life continuity plan.
Life continuity
plan. Great. Right? And third strongest pillar, of course, is you should never be in a position to think that, hey, you know what? Rather, people are in confused state. I'm earning money, right? But in 15th, let's say first week of the month, you get the salary, and then by 28th, 21st,
it's blown up.
And when we ask what happened, we don't know what happened. You tell us what happened, right? So we need to move from the point of confusion to point of clarity, which means that you need to be completely aware of your finances, right? Irrespective of the fact you engage a financial planner like me or not, it's your money, man. You got to be responsible for it, right? Know where you got it from, where it went. Simple Excel file is enough.
Okay.
Keep that, and I think most of the problems are solved.
So 3 points. 1 is insure yourself so that you are mitigating your risks.
Yes.
The second part, and that would probably entail even diversification. So mitigate your risks, involve your family, be transparent, have an open conversation. And the third was?
Third was is have a correct budget.
Have a budget, yeah.
And manage your cash flow. You know where the money is coming in, where money is going out.
Great.
Just knowing. Awareness is the first step.
Wow. And you're saying this out of experience that a lot of people might just not be able to, right?
Is it okay if I give you one example? Real story of, I will not take the name, of course. He's a CEO of a private company here in India. And, doing pretty well. Actually doing really well. And he was also the owner of the company, right?
Okay.
He takes home close to 50 lakhs a month.
Wow.
Salary.
Okay, that's amazing.
50 lakhs a month,
yeah.
Right? And then he came to us. When I say us, it's because what we do is that we don't help people in the intelligence quotient, IQ alone. We also do EQ, emotional quotient, right? When we worked on it with him, what we realized was he had a lot of things that he had, hangover from his parents, right? So there were some behavioral aspects of him. Genuinely, he didn't know that he was actually blowing up. The question is, he didn't know he's blowing up, right? And by 2025, imagine from 50 lakhs, he's like few thousands.
Oh wow! Okay.
He was not even aware that he's spending.
Sure.
It could be sometimes mere ignorance, or it could be that habit of not.
And they don't know. See,
I don't care.
Don't know. We're not aware of what exists for us to make an investment in that space as well. There's a lot of knowledge gap that's existed. So Vivek, I'm very curious to understand if there's economic uncertainty. I think your fundamental rule number one sort of addresses that, where if there is fluctuation, etc., you have some insurance that can help you. You have some diversification of your investments that can help you. But if there is so much like a turbulent time, okay, economically, is there anything more that we should do to safeguard our interests?
Oh yes, I would give around maybe 4 things to do that. Okay, number one is really look at. Number one is, of course, cut down your expenses. Further, again, my previous point that I mentioned, you need to be aware of where your money is going.
Yeah.
Right. Once you have the record,
something you're saying general rules. So you don't have to wait for like a COVID situation, problem, etc.
Exactly. You don't need uncertainty, economic factor to kick in.
Yeah.
So reduce your expenses.
I like that.
And from my thank you. And from my experience of working with people, I would easily tell that close to 30 to 35% of the monies that they were spending were unnecessary. Completely unnecessary. And imagine if someone is getting 1 lakh a month, right? 35,000 bucks a month. If he's putting in simple SIP mutual funds, he's up for creating crores wealth, right? So number one is reduce your spend. Okay. For that, you need to know where you're spending money, right? In terms of uncertainty, right? People what they love. So, for example, I'll give COVID as an example. Right? It was an uncertain, turbulent time, right? That time. People started to get into many other things. Hey, let me do that, let me do this, right? I'll try that, I'll try this and all. So actually it was good. Because of that, people started to learn more and get yourself more acquainted with what's happening, get more financially literate, and try to have some passive sources of income. Never be dependent only on salary, never be dependent only on your business, right? When I say passive sources, it's not only through hustle or do some online business. It could also be that having a good investments made, that fund itself can actually give you passive income. Dividends.
So simple. Spend less, have a passive income.
Correct, right? And learn more, right, during those times.
Learn more.
Yeah. And third one is reposition your investments. Very important, which is more often overlooked. Or maybe, sometimes, people get overfunded.
What is repositioning of your investments?
Give you a simple example. Let's say James Bond. Okay. James Bond is investing here. And his portfolio consists of few stocks, shares of maybe around 10 companies, and mutual funds, some debt, some gold, some real estate. That's all his portfolio. And maybe repositioning means that he must have had overexposure in equity. Equity is consistent with risk, right? It's a risky asset. It's a simple thing. Equity market, why it goes up and down? Why? Because of only 2 fundamental emotions of human beings, fear and greed, and that's at the highest when it's uncertain, right? People start selling off. When it sells, it falls down. The value, even if you're holding, it comes down, right? So repositioning is whichever in the particular equity, stick to or rather move the funds from the mid cap or small cap securities to the large cap ones, right? Blue chip, the stable companies which have been consistently giving returns, even though small returns, but move your funds from there.
So what you're suggesting is it's not a bad idea to roll your investments from one investment to the other when you can switch it around.
You must.
And can you do that even like one is equities, it's a different game, right? But even between your other assets, let's say gold and FD, right? It's not a bad idea to keep switching it around.
Of course, 100%. You must do that. I would rather say, have more liquidity.
Yeah.
That was my fourth point, in fact, right? Fourth point is that the third one was on repositioning your investments. Yeah. Fourth is actually have more liquidity. You need to have access to your funds when you want to use, right? But don't be over liquid. No need to get into over liquidifying.
Yeah.
No need to sell all of this and just keep the balance in the bank.
Yeah.
That's not a good idea.
But keep some so that you can have access.
I would say, at least 6 months of your earnings.
Yeah.
That's emergency fund.
Okay, so let's recap so that we can really bring it together, right?
Yeah.
Spend less. Reposition your assets whenever that is, switch it around. The other part is
third one is invest more time to learn more.
More
and have passive income.
Passive income, definitely. Yeah. And the other two are
liquidify. The fourth one is have liquid, right? Yeah. Emergency fund, which should cater to 6 months of your expenses. What I mean by that is simple thing: move the funds from some of your assets, sell them off, and the money either in your bank, not FD, or RD, recurring deposit, which you can, or liquid mutual funds, which you can actually, at your behest in 2 to 3 days, you'll have the funds in your bank.
Okay.
That's important.
Great. So the fundamental thing, as we're talking about all of these different terms, right, and different instruments of investment, many people may not know it. So before we enter, helping people understand exactly what they should be trying to invest in, etc. In the last 10 years or even 15 years in India, right, what is the sea of change? What has exactly happened? We were able to move away from FD to so many other things, right? Can you sort of help describe it?
The biggest wave that what we have witnessed is a lot of people have gotten into stock market, equity.
Yeah.
And many there are new first-time home buyers. That means that most of their investments are actually in buying homes.
Oh, okay. Mm-hmm.
Okay, that's I wouldn't call it as it's more of an emotional decision, right? It's not a financial decision as such. And RBI and SEBI has done great job in creating awareness, especially during COVID. Until 2019, the financial literacy was very, very less.
Sure.
I would keep around maybe less, 15 to 19%.
Yeah.
Okay. And the latest statistics actually state, especially in the urban population, the financial literacy rate is actually as high as 62.6%.
Oh, wow. Okay.
From 19 to 62.6%.
That's amazing.
And that's happened in the last 4-5 years.
Yeah.
Because of that, a sea of change that we have seen is there's a lot of influx of people moving into mutual funds.
Got it.
Okay.
Yeah. And then you had the boom of like Zerodhas of the world.
Precisely my next point.
Because it's at your fingertips now.
Exactly. Right? A lot of apps, right? Digital interfaces. So many other names.
Brought the market to your home, right? Actually to your fingers. So yeah, that's the biggest transformation, I think. To sort of remove a lot of our fears. Like personally for me, I was raised in a home where they said, oh my God, that's gambling. Stock market is gambling.
Gamble.
But the truth is, if you understand it well, and today it seems cleaner, so you're able to sit down and understand and track your money every minute. Right? So that's the biggest transformation, I guess. Yeah.
I mean, of course, it has its own plus and minus.
Yeah.
Plus is that yes, you have easy access to you can actually have your money work for you better.
Yeah.
The minus is that there is no personal touch. Mohana, from what I have heard from a lot of people whom I work with, right?
Yeah.
My set of investors. They love me for what I do is because I'm going to say me. I'm talking about me and my team, right? Because there's a personal touch. They want someone to be a call away.
Yeah.
A personal CFO. Hey, listen, this month I have so much money, I don't know what to do.
Sure.
Right? Or I have loan that I want to close. What to do? Some of the other financial advice they want. Yeah. And these apps are great for investment, but there's no personal touch. That's one missing point.
Okay.
Yeah.
So let's list exactly what financial instruments are present today for anybody in India to actually look at. One is FD, Then there's gold. There's basically gold bonds and actual physical gold. Then you have homes. You have home slash land, which is like your brick and mortar, right? You want to touch it. In that space, you also have what do you say? Commercial
Real estate.
property that you
Yeah.
can take and rent and stuff like
Yeah.
that. Then you have mutual funds, or you can go directly and buy a stock. Then you have LICs, insurance, that also grows, right? Anything I'm missing? I got 7 types of financial instruments. What else?
So in my latest,
Yeah.
training that I conducted, I showed people 40 ways to invest. Right?
Sure.
Stock market is one thing.
Yeah.
Was another thing.
Yeah.
Never get into trading. Right. Then you have gold that you mentioned.
Yeah.
It's we also have something called e-gold.
Yeah.
Not only physical gold, e-gold, gold bonds.
Yeah.
Right. SGD, sovereign gold bonds, and all that.
Mm-hmm.
Then there's gold ETF,
Yeah.
exchange traded funds.
Mm.
Then when it comes to real estate, you mentioned land slash plot or other site, right? Or home people
Yes.
buy. Then commercial property, right?
Yeah.
There's also, when it comes to commercial property, is further drill down that really happens. Because let's say, simple thing, we live in one maybe CBD, right? Central Business District. And let's say, in Bangalore, there's an area called Whitefield. Whitefield has a lot of tech parks. How can Vivek or Mohana be owner of a tech park? It's quite crazy to even think, right? You need to have maybe a few thousands of crores to do that, right? Forget, tech park might have around 12 towers. In that one tower you take, forget the entire tower, just take one floor. In that one floor, maybe one conference room, you can still invest to that.
Nice.
You can buy. It's also called, co-ownership, fractional ownership.
Sure.
Then, we have ELSS, ULIP that you missed out, right? Which is equity linked savings schemes and unit linked insurance plans. Then, there are many other asset classes. I think all of us watch Netflix, right? Or Hotstar, some TV series and all that. When you watch them, you'll be like, wow, great, right? Imagine you having to get to know about this something coming up maybe 1 or 2 years back itself, and you're part of the project.
Yeah.
In movie production, OTT platforms, you can invest in it today. You can invest in arts and paintings, co-ownership, which gets auctioned in New York, an auction house for like $1 million or more, right? You can invest in music productions.
Interesting.
You can invest in invoice discounting. You can invest, for short term, you can invest in unlisted market.
Yeah.
For example, Bira. Right?
Yeah.
There's some company called CIGS.
And
right?
unlisted pre-IPO is a new concept. It's coming up now, right?
It's never a new concept. It was always there. It's the awareness is now spread up.
Yeah.
Right?
Sure. Yeah.
For example, there are a few of those things that I personally put in a few of my funds there. Right? To, at the time when they have started, or now I know for the next few months they're going to go IPO. I picked up the shares right now.
Correct.
Right? And when they go to IPO, I'll be making some short profit. Right?
Yeah.
Like there are many others, very, very different. And there's something called P2P lending.
Okay.
Peer-to-peer lending, where you can actually earn interest. Right? Out of all these things, 3 things, Mohana, I would like to categorically and strongly recommend people not to do.
Okay.
Never to get into it unless you're a pro at it. Is trading. Trading is not for beginners. Right? Start your journey with simple SIP mutual fund. Understand the market. Let it take more years. Don't be in that hurry to make that money.
Yeah.
Okay. Second thing is crypto trading. Third one is something called forex trading. Yeah. Please stay away from it.
Okay.
Simple.
Okay.
Answer is as simple as that. Stay away from it.
Unless you are an expert, you've learned, you've studied it, and then gotten it.
Unless you're an expert, you've learned, you've studied, you put your money, you've lost money, you've gained.
Yeah.
You understand the facets, and you know how it all working.
Okay. Yeah.
Then it's okay.
So let's bring it together. 5 new age things that I heard from you, and then we'll do the ones that really more people know. You have commercial property. You can fractional property, as it's called. You have arts. You have music or movie productions. Watch out for that. You have peer-to-peer lending. So there are 5-6 new things that are emerging.
Many more, but these are the ones that is
the top things that are trending, sort of, right? In addition to that, you always have mutual funds. You always have ELSS. You have insurances. You have FDs. That continues, right? Essentially. So I'm curious to understand, what is peer-to-peer lending?
Simple. I am a business owner, right? And I want some funds, right? What are the ways I can actually raise funds? One is, if I have a company, I can do I can start telling people, hey, listen, I have a company, just
Yeah.
buy the shares. Second thing is I can take bank loans. Right. Third one is, I raise funds through FFF, friends, family, and whatever, right? And or sometimes when crowdfunding. Another one. The other one is P2P lending, right? Where there are platforms where I can go put my request saying that I want so much money. This is who I am, my background, right? These platforms also do some type of checks and balances, background
Of course,
verification,
yeah.
who I am, what I'm doing,
Yeah.
why I'm raising the funds for now. And that platform also has people who can put in small amounts to invest, right? And let's say they put in all the money and actually they give money to me.
So there's borrowing and lending.
Borrowing, simple thing like what a bank does. Here, instead of bank being the authority to give me a loan, here a lot of small people are authorities to give me the money,
Interesting. Okay.
and they get the interest back.
Got it.
Again, I would like to tell you that it's a risky.
It is a risky,
It's a risky
one, right?
proposition.
But it's there. It exists. That's what we want.
It's an informed risk.
So Vivek, now that we know that India has so many different options for financial planning, I would love to talk about, what should we do per decade of our life, right? And the youngest I can think about when I started earning, and most people step into workforces in their 20s. So what should 20-year-olds actually be thinking of? Where should they be, actually putting their money and investing?
Number one, get your budgeting done right. Right. Second thing is start investing in simple SIPs.
Yeah.
Start with SIPs and stick to that, right? And keep upping the game. When I say keep upping the game, let's say first year you're investing maybe around, let's say, $10,000 a month. Second year, increase it by 5%. Make it 10,500 per month. Third year, again, maybe 11,000 a month. Like that, keep upping it. Then you can actually think of this way: most of the investments that you're actually making, make sure close to 80 to 90% of your investment you can do it through mutual funds and a portion of equity.
So 20-year-old can do 80 to 90%
yeah.
SIP. That's a risk they can take.
They must, I would say, because younger the age, they have more time to risk that can be taken.
Correct, yeah.
Right. And 10% keep in, say for options, right?
Yeah.
Insure yourself, number one, pay your premiums there, right? Number two is, maybe start investing in some bonds, right? To have one definite way of, getting some, money there.
Yeah.
And, keep buying gold. Okay? Even if it means, 1 gram coin every month, physical gold, go buy it.
As a 20, in your 20s, these are the ideal instruments to take. Ideal. Okay. And if I'm 30 and in my 30s, how can I actually look at investing, and what should I be doing for my investments?
There are two scenarios.
Yeah.
When you're 30-year-old, you're either married or about to get married. The focus has moved from, hey, fun and frolic to having some type of settlement done, right?
Sure.
Some type of stability in terms of career and also personal, right?
Yeah.
You may want, if at all, scenario one is you already have a house. Maybe, your ancestral property has come to you. Or second scenario is you don't have and you want to invest in one.
Yeah.
Right? That's a good decision. But I would like to tell one quick comparison of finances. If at all you take a loan for 20 years and you pay EMIs continuously, you actually pay 2 times the money you borrow from the bank. Let's say you borrowed 1 crore, you actually end up paying close to 2 crores.
Sure.
Right? To the bank because of the interest. Second, instead of that, let's say for 20 years, instead of paying the EMIs, stay on rent, 50% of the money pay on rent, 50% invest, you actually still make a lot more money than the value of the house, which is after 20 years that you're up.
Yeah.
So that's something which you need to be, make a very, very weighted decision that you take along with your partner. Otherwise, have any age group, 20, 30, 40, 50 or anyone, most of your exposure should be in mutual funds.
Right now, that's the era we're in as well. So 30-year-olds also can put more than 50% of their investments in mutual funds.
There's one rule. Okay, all of you remember 100. 100 everyone knows, right? 100 minus your age. Let's say I'm 44. 100 minus 44, 56. So that's the percentage of exposure I should maximum have in terms of high risk investments. It can be in equity. I'm not saying mutual funds are completely safe. In the mutual funds, if you have more equity exposure, it's as good as equity, right? Equity oriented mutual funds or any other high risk investments should be maximum 56% of my portfolio. So 100 minus your age will actually define.
Got it. That's great.
Simple.
That's fantastic.
Yeah.
So we'll come back to 30-year-old. So what you're saying is, if I'm in my 30s, I can still continue investing in SIPs. I can think of property, but I need to understand the risks, the plus points, not so plus points, and then weigh it out. And you said continue to buy gold.
Continue
Right.
buying gold.
Gold, okay.
Gold, see, the reason is when everything fails,
Yeah.
when I say this, many people laugh, but I think a lot of people have started to realize is that have physical gold.
Yeah. Those bricks,
The
right?
idea, it can be a coin. A
Yeah, of
simple
course.
1 gram coin,
Yeah.
right? Even less than that. Right? Idea is you cannot have your life controlled by anyone.
Yeah.
Right? You need to be, independent. You
Yeah.
can have independence when you have something, by your side.
Yeah.
Right? So gold and equity market are like, the other side of the weighing scale.
But the thing is, it doesn't lead to distress sale. It's actually with property, etc. What I have noticed is when you really want to sell it, it's hard to find a buyer
Correct.
at the right rate. So these are the other instruments that people can actually utilize. So let's move to 40s. Exactly what should I do in my 40s? How should I play with my money?
By 40s, you'll be in the brink of almost closing all of your loans, number one. So you'll have more of money at your disposal, right? That's when you can actually start looking at, apart of course, the simple thing, mutual fund is there, SIP is there, continuous, you have your bonds and gold and all that. You can actually start taking a bit of risk, a very small risk, in terms of being an investor in other businesses, right? Investing in startups.
Yeah.
In terms of angel, right? Angel funding, or if you have some good amount funds at your disposal, you can actually look at being associated with VCs also to put your money there.
Yeah.
Right, one way.
Yeah.
That's where the things like unlisted equities and when it's startups investing, not all of them will actually make good money, right? 20-80 Pareto analysis that really works here also. 20% of your investments, let's say 10 companies you've invested in, 10 different things. Out of the 8 might not work very well, or 8 might not work at all, but 2 will work such a way that it'll give 80% of the returns.
Got it. Yeah.
Same thing in this also. So when you're in 40s, look at getting into different these type of investments.
Yeah.
But very important, don't put all the fruits in one basket.
Yeah.
I don't say eggs, fruits, right? Make sure that you have small amounts invested in different things.
Yeah. So further diversify your investments.
Yes.
Okay. And let's say I'm in my 50s. What should I do?
In your 50s, maybe you're in a age where you're thinking of actually retiring, and you're like, hey, you know what? Enough. I have worked hard. Now it's time for me to actually have a good life.
Yeah.
Right? You need steady, stable, another parallel income coming your way, right? Keep your entire exposure to this to be anywhere between 40 to 50% in high risk assets.
So at the age of 50,
at the age of
50 should be 50%.
Maximum 50%. So I would say even 40. Bring it down to 40% towards your equity and other exposure, because that's when the wealth has actually grown. You have a lot more money. Right, 40% is still a big money in terms of these high risk investments that you have.
Totally.
The balance amount should be in bonds, corporate FDs, right, which are fixed income giving instruments.
Interesting.
PSU bonds, government bonds.
Yeah.
Though it will give lesser, it should be a predictable income for you.
Yeah.
Or other great thing, not many people are aware of it, is there's something called, SIP. SIP is what you're putting in to mutual fund. There's also SWP. You're taking out from you're withdrawing.
So when's the right age? Like, is that what you start doing when you're a little older?
Yes, that's preferable then.
Yeah.
Right? Because what happens is you start withdrawing some, because that's when you have accumulated good amount of funds.
Yeah.
From there, you start pulling out small funds. It not really hurt deep pockets, because at the same time, whatever fund is there, it's still growing in value also. Yeah. The same way you're actually enjoying it. So SWP is a great option.
So SWP essentially allows you to take the money out, live with it, plus you can reinvest it somewhere else also.
You can.
Yeah.
No, but the SWP works mainly on mutual funds, right?
Yeah.
So let's say, example I'll tell you. An individual throughout life worked hard, has accumulated, let's say, around his total mutual fund value is about 5 crores.
Yeah.
Out of the 5 crores, let's say he starts pulling out 2 lakhs a month. Right? The first month he pulls out 2 lakhs, he still has 4.98 crores. That is still growing in value. The same way he's pulling out. So It doesn't mean that 2 lakhs you keep pulling out and one day its entire thing is zero. No. It'll still keep growing.
money
So your
keeps
fund
growing.
also is growing up and you're also actually enjoying. It's a great option for 50-year-olds.
When you're a little older, you can
Withdraw.
actually withdraw it. That's
Yeah.
wonderful. And within mutual funds, there's balance advantage funds where anytime you can go and withdraw.
Yes.
So it's not locked.
It's
Right
not
now, the
locked.
government has a locked period, right? Great. So that's wonderful. What is ideal for me to have in terms of my money when I'm in post-retirement, 60s plus?
Very good. I was actually hoping to that you asked this
Yeah.
question. See, by then you would have your PF balances. You have some type of, if at all, you have done a financial planning and you've got some retirement fund already and you've created a corpus. Put all of them in, majority of them, I would say, in fixed income giving bonds.
Sure.
Number two, maybe I would say 60% of your money, 60 to 70% should be in these fixed income giving securities.
Okay.
Never ever take exposure to equity then. It's
Yeah.
not worth it.
Yeah.
Right. Of course, if then you have your kids earning and all that, so you don't want to be really providing for their expenses, they'll take care of it. And then
A fixed income bond could be like an LIC bond also.
Yeah.
Similar.
PSU
to that.
bonds, and there are a lot of private bonds also.
Okay.
Bond is what is basically companies taking the money on loan.
Yeah.
It's a bond.
What about an FD at that stage in age?
That's also great. A portion. So when I say fixed income giving securities, bond
Even-
is one thing,
Yeah.
FD is another thing, right? Like that we have multiple products by itself, then, right? And a small portion of the money
Yeah.
can be put in something called AIF or PMS,
Okay.
right? I'm talking about, let's say, 50 lakhs.
Yeah.
Right. Alternative investment funds
Okay.
or portfolio management services.
What is that?
What they do is, so let's say there are some fund houses,
Yeah.
right? Well
Yeah.
reputed fund houses. What they do is they take this money and they further invest into different equities and different sectors. Okay. By that, let's say I would say that 50. Let's say if you have 5 crores, 50 lakhs, 10%, you can still take that risk. I would recommend take 10% risk. That's okay. But 90% is in safe ways. In the 70% in your bonds, 20% in mutual fund SWP.
Sure.
That 10%, right, where you're putting in the PMS, that will grow actually in value,
Okay.
provided you're not dependent on it
Yeah.
and don't wait for it.
Got it. Got it. Interesting. Very, very
Sorry,
interesting.
one more point.
Sure.
One more point. By then, you're in an age where your expenses would have increased. So many hobbies that you have got missed out in your life. You may want to be traveling more, right? And health-related concerns would increase. Expenses might increase. So make sure there's sufficient coverage of insurances.
Yeah.
Cardinal rule.
Yeah, and a lot of older people don't want insurance because they believe they have enough corpus, they have enough money.
Exactly.
But what they don't realize is one bad disease can wipe out that money because medical prices are
crazy.
so expensive. So get a good insurance.
Yeah.
Keep growing your money towards that as well, right? Wonderful. And how do I ensure that time and again I like the fact that you mentioned one of the rules of the game for financial planning is to keep repositioning your money, to keep moving it around. So I think that sort of partly answers the question that I have for you. But how do I know that I'm probably making a mistake and I have to rotate the money? Right? What should I do to ensure that I'm sort of observing that it's actually growing?
When I answered, people need to be aware of where the money is going.
Yeah.
Right? On a monthly basis, whatever cash they're getting on a monthly basis, where the cash is going. That's from the inflow-outflow perspective. Same time, you need to be aware of where all your money is invested.
Yeah.
That's called your portfolio, right? It could be some in stock. Or as an investor, it is your responsibility to demand from your finance expert a dashboard.
Yeah.
They'll show where the money
is. Yeah.
Right? For that matter, SEBI has done a great job in making sure most of the investments are now in demat form.
Yeah.
Right, and monthly reports that is being sent by CAMS or whatever, it contains everything in which ways.
Correct.
Number one thing that you need to keep in mind, I'll give you a number. Okay, this is my personal. It's not an investment advisory. Is that I always expect my investments to give me returns of average 14%.
Yeah.
14%. If you're not earning 14%, something is wrong in the way. Either you're fearful. Or you're okay with 12%, 11%. That's also great.
With this kind of a market growth, we can expect 14% of what we're saying year on year,
yes,
every single year.
Yeah, keep a range of 12 to 14%. I would say. Right?
At least 12 is your
12 minimum you have to earn. Otherwise, you don't need to even. It's a no-brainer. Just put the money in FD.
Correct.
Simple, right? So if at all your entire portfolio, the returns that you're getting in some investments which is giving less than 12%, it's time to move around.
Okay, got it. Just keep switching around. That I think is a great rule.
Yeah.
Rule of the game.
I'll give you one story. Yeah. This couple, sir, he works for a reputed, he's a scientist, right? And wife, she works in a college as a professor. And they've had some, very good investments made. Though they were not very aware, they were banking on one financial expert, and it was pretty decent. But when I took a look at it, right, what I realized was, though they had great, mutual fund exposure, one of the biggest chunk of overall around 2 crores of their investment, 70 lakhs was in something called liquid fund. Okay, liquid funds will give you like 5%, 6% returns per year. That is still okay. Then when I asked them, why do you want so much liquidity, right? 60, 70 lakhs. Why you want so much? They didn't have an answer. They're like, no, we just went with what he said.
Recommended,
right? Then we, worked on it again. We repositioned and all that. And in 1 year, they have actually seen a substantial
change.
Growth.
But that's the reality. That you may get a recommendation, but you have to also do your own research, right? You need to do your reading. You need to understand the instruments. You need to also give it time and really 100%. Know what your returns are going to be.
Correct.
So I love what you said. Time and again, check if you're at least getting an average of 12% in this kind of a market. You should be far higher, but then reposition, rotate your money as well. That's great. So did we talk about retirement planning was one very important thing. I'm so glad we talked about it. But in your view, what is the most emerging trend that we should observe that actually can help us sort of get a better future in terms of financial planning? So what's the emerging financial instrument that we should all watch out for in the next decade?
Digital real estates.
Okay.
E-real estate. Right?
E-real estate. Yeah. Okay.
Using blockchain as a platform.
Yeah.
Okay. And third thing is stick to emerging or not. Some things are like time tested, right? Stick to gold mutual funds all the time. I would say these 3 things.
Gold mutual funds or
these 2 mainly.
Gold mutual funds. Yeah.
Right. Okay. These 2 are your safe bets, right?
Yeah.
The other 2 are high risk, right? Emerging ones and real estate. It's actually, how do I say? It's a very, very interesting phase wherein a lot of people are scared, skeptical, including the regulators and governments, because of the sheer volume of scams and frauds that have happened. People have misused it, right? The technology is great. Blockchain is a great technology. I am a firm believer in it. So there might be a time where you like it or you don't like it.
Yeah.
You love it or you hate it.
Yeah.
You have to get onto the bandwagon of eventually. For example, Supreme Court in Dubai right now has given a green signal for all the companies in Dubai to start making salary payments in crypto.
Yeah, a lot of and there are companies which actually give you benefits in. They give part of their salary in crypto. There's a lot of stuff that's actually transforming as well.
Correct. Yeah. And there are more than 21 million coins, different type of coins. We talk only Bitcoin, Ethereum, just few.
Correct.
There's so many others, right? Yeah. Which one to go for? Which one to go not going for? What people generally think crypto means. Hey, Bitcoin today is around $88,000 each coin. In 2009, it was available 6 rupees, Indian rupees.
Yeah.
Right now, people are still thinking, okay, Bitcoin means if I enter, everyone will make money. No.
Yeah.
That's not the truth, right? Don't get into trading of buying at a lower price and selling at a higher price. You can do that only if you've studied the market and you've been there and done there at least for 2-3 years.
But you can still invest now.
You can still invest in some upcoming new coins which has a huge potential, which has a technology backing.
Yeah.
That's the most important thing.
Yeah.
People don't, so they don't never go for herd mentality.
Yeah.
What you see online, right? Instagram and there's some crazy,
of course,
scam related ones. So stay away from it.
But even I think one of the problems in India about crypto is what app you actually use to trade. That's what the governments are going after, right? That which app is the right app that's actually having, giving you access. And that's really one of the biggest concerns in India.
And to counter that, I have something to tell you this, right? I'm just trying to make everyone understand.
Yeah.
When we say app, right, we're talking about, it's called an exchange, right? Like today, if you want to buy and sell shares, what do? You buy through stock exchange, right?
Sure.
Similarly, that's exchanges. Binance is one of the exchange which got banned in India. Now again they're back. How or why? Why it got banned? Let's understand that. Exchange in Indian government there's no act. Right. Regulations are still being formed. Right. So as a temporary approach, there's something called Financial Intelligence Unit, FIU. Okay. It oversees a lot of people can actually go and complain with FIU if their money has been mishandled. Right. FIU has been given a temporary thing to give approval if the particular exchange is actually compliant with Indian laws, regulations, then it gives approval. Okay. But a lot of players who didn't have, that's when Indian government banned them. Now, there are a lot of these exchanges which are CoinDCX. Right? Now there's a recent, very big one coming up. It's called CIFDAQ. Okay, it's also an exchange which has working with FI to get the approval. Like that, there are some exchanges that people can use. So apps per se is a very a dangerous thing, I would say. As an app, what it's basically, it's like you see it on a Play Store or App Store on your iOS device. You like it, just download, you start trading,
and you don't know who's behind. We did a cybercrime show,
exactly,
and the lady was very clear. She said, "You don't know who's behind the app. It's not just that you log in and you have a safe number, but who's behind those apps. So be very conscious about checking all these things before you download it."
See, another thumb rule: if you want to invest in a company, or a mutual fund. Right? Would you go for someone new? Or would you go for someone time and tested? Right? Or as an investor, what you do? You just do some type of research, right? Who's this company? Who are the founders? Their backgrounds.
Correct.
Right? Are there any criminal cases against them?
Yeah, of course.
Right? Do they have a director identification number? And what's the line of business they are into? Same type of checks do here also, no? Instead of just blind, don't be blind. Be an informed investor is what I request everyone. So,
that's so nice, Vivek. And as we come closer to the end, I want to know, like, from all the amazing things that you've done to help people, right? Tackling the Indian mindset of saving versus investing, all of that. What's that thing that comes to your mind that everyone should know? What's your advice for us as we start or we end our life? Your financial planning mantra.
It might sound funny if I have to tell. Don't be attached to the results. Okay, of your finance results, it will come if at all, provided you take the right actions, right decisions with the right mind. It's so when you're actually doing all these things, number one, you understand that it's not your responsibility is not only for you and your family, a bit of it towards the society also. Right? When you're doing this financial planning, whatever, the one question I ask people, like, hey, what's your retirement now? So yesterday, some people said 100 crores, 50 crores. I said, great. What will you do with the money? Okay, they said, I'll go buy that, I'll buy this. To a certain extent, then what? Then what? So always have the end goal in mind. Hey, I will create so much corpus. Have very good clarity of why you need the corpus and what will you do. Visualize yourself. If not, work with, take help, seek help and get there. And finance is not difficult. Finance is actually very easy, but unfortunately, it's not been taught the right way. It's been made to look confusing. So many jargons and terminologies. But if you really see the bottom line, the fundamentals, you stick to it. So fundamentals, when I say Mona, it's very simple. Your cash inflow, cash outflow. Have 100% clarity of that. 99% of your problems are solved. Okay, keep that in mind. Another thing is, please, my earnest request is never ever take investment decisions based on emotion. Okay, you need to remain equanimous. No fear in green.
No fear, no excitement too much.
When you earn high, like I earn, I go, first. No, don't do that. And when you're losing, like God, I lost. Right? Start blaming the world. Don't do that. Remain equanimous. Alright, it came up, it went down. Again, it'll go up, again come down. Have you ever seen any stock market? It's always given just trade returns. Never. Right? Your heart also beats like this, no?
Correct.
So simple.
No, that's great. That's wonderful.
And just one more thing is never ever take a decision, investment or financial decision based on emotion. And also don't, go to the only YouTube channels or Instagram or Facebook, social media. It's good to learn, be informed about it, but your decision should not be based on that. Always take individual, finance expert related opinions.
Wonderful. So on that note, I learned a lot. What I loved is understand the market very clearly, diversify. I loved repositioning your portfolio time and again. I like the fact that in today's Indian economy, we can aspire for a minimum of 12% at least return, and that's very, very important for all of us to know. And more than anything else, I love the fact that you shared all the new cool things that are trending that we can actually go and study about, right? Peer-to-peer lending to actually getting fractional real estate. Those are things that not everybody sort of knows, understands, and I'm happy to explore as well. What about tax is hurting people the most, Vivek?
See, Benjamin Franklin said, death and taxes are two things that you cannot escape.
Yeah.
Right? So, taxes you have to pay.
Yeah.
Right? Number one is never ever, always don't avoid tax, instead plan around it. Number one. Right? Number two is that when you have to take tax benefits, don't link your investment decisions to what tax benefit I will get. Tax benefit is the last one. See how we can earn more money. Now, when it comes to taxation here, for let's say, for example, salary classes, there's so many benefits of tax that they're not
deductions, right?
Deductions they're not able to actually take. First question is the difficulty what people go through. Hey, should I stick to old regime or new regime?
Yeah, yeah.
Okay.
Yeah.
So again, based on my analysis, what I've actually seen is number 15 lakhs is one benchmark number. If your taxable total net taxable income is 15 lakhs and above or 15 lakhs and below, right?
Got it.
Yeah. If it's below, go for new tax regime. If it's above, stick to old tax regime.
Old tax regime. This is a great tip.
Provided that 15 lakhs and above, those guys are actually taking all the benefits of deduction under Section 80C, 80D, 80CCC, whatever they have, right? Everything they have to take, benefit. Then it's more.
And this is what I have been observing, that people who are not earning, like, let's say they typically earn less than 20 lakhs, okay? The construct of Indian taxation system is to help them. And most of your deductions actually help you, save more money, have it in your pocket. If you're crossing 50 lakhs an hour, it doesn't help anyway, right? You're a completely different ball game. And they are the ones who are largely not keeping their bills, not submitting and claiming deductions. I don't understand why. I don't understand the psychology. But this is really happening. There's a lot of, information that they're not reading about. They find it painful to keep their bills. But you can claim, you can have a lot of money extra in your pocket if you're earning a little lesser, right, comparatively.
True. So the one thing is, my team of CS, what we do is, what we advise people is, hey, listen, the moment you have some information or any spend that you have that you think you can actually take, again, you need to, as an investor or as an individual or a responsible Indian, simple, you need to be aware of tax laws. Sorry. Ignorance of laws is not an excuse. Ignorance is not an excuse. So if you don't understand, fair enough. Ask your CA. And it's your right to ask. Ask and get the information.
Second thing, get a CA.
Get a CA, man. It's so easy today, right? And the second thing is, listen, all of us have smartphones. So if someone is saying that, hey, who's going to maintain the bills? Are you kidding me that you don't have 5 seconds to take a photo of your phone and just WhatsApp to your CA? Or put in a drive. Google Drive.
And so many people are like, with children, they don't have a single rupee at the end of the month left, but they're not planning. So this is such an important conversation that we have. It was a pleasure having you here, Vivek.
Likewise.
And thanks for sharing all the wisdom that you hold and help people with.
Thank you. Thank you. Wish you all the best, guys. Okay. Thank you for doing a wonderful job of spreading this awareness. Much needed for people. And I'm really grateful that I have an opportunity today to address you and all of our audiences.
Thank you so much.